Hey everybody, welcome to SRT Live with your host, me, Sean Richard, with the Sean Richard Mortgage Team. Thanks so much for joining me today. Today, it marks an important day. We've got Fed Week this week, and we're going to be talking and diving into that. Really, with the Fed, it's darned if they do, darned if they don't. They've got a big decision with the interest rate, the Fed funds rate tomorrow. So we're going to catch up on that tomorrow, but we're going to dive into the news today. We've got action-packed slate of information both this week, and we had a slew of information last week as well. So let's dive into the week in review. Last week, we had CPI and PPI, both inflation reports come out. CPI, remember, is Consumer Price Index. That is inflation at the consumer level. And PPI, Producer Price Index, that's going to be inflation at the producer or wholesale level. And CPI came in pretty hot month over month. It was up 0.4%. Now that was right in line with expectations. So we didn't get some blockbuster crazy high inflation number. But since it did come in line with expectations and did not beat expectations, the market didn't necessarily love that. Now, year over year, inflation has been staying pretty stubborn at 6% increase year over year. So we've got to see that number come down if we're going to see interest rates, mortgage interest rates come down. Because at the end of the day, I'm in the mortgage space, you guys are in the real estate or home buying space, and we want to see those rates come down a little bit. So inflation has got to continue to come down. We're still at that stubborn 6% level. Now, some good news with PPI, with the producer price index, that came in below estimates. So what we can expect maybe on next month's CPI report is that we could see inflation start to decline at the consumer level with the information that we got at the producer level. So producer price index month over month came in down 0.1%. Now this was versus an expectation of up 0.3%. So some really, really good news at the producer price level, showing that inflation is declining from the kind of the lag that we've had. We saw inflation decline for a few months, and then we saw it kind of get stubborn and stick around. And now, hopefully, this is a prelude to a decrease in the consumer price index next month. Now, year over year PPI, we got 4.6% inflation versus expected number at 5.4. So again, a phenomenal beat at the producer level. Now, one note I'll make between the producer and the consumer inflation levels is producers don't have to pass inflation costs on to the consumer. So they could take lower margins, they could make up that difference in other ways, but they don't always have to pass all of that along to the consumer. So there's always going to be a bit of a discrepancy between consumer and producer price index, but seeing the producer price index come down is a good sign for future consumer price index reports. Now, last note on inflation with the consumer price index is the Fed's mandate is they are trying to bring core inflation on a year over year basis down to 2%. Right now, core inflation at the consumer level is sitting at 5.5%, 5.5% year over year. So the Fed still has quite a ways to go to get to that 2% mark that they're shooting for. And that's why the Fed has been talking so aggressively about combating inflation and doing additional Fed funds rate hikes. So really important to watch and listen to Jerome Powell tomorrow. Now, we also got home builder sentiment. This is home builder optimism. This is in the National Association of Home Builder Housing Index, NAHB. And this tells us how optimistic the builders are at the new build construction environment going forward in our housing economy. And anything below 50 is considered a bit on the pessimistic side. Anything above 50 is considered on the optimistic side. This had been in the high 30s, low 40s. We are starting to see it creep up a tiny bit, came in at 44. So builders still a little bit gun shy on what they expect to see in the housing market going forward, but that has crept up a little bit. Previous reading was 42, so we're coming up a little bit. We also got housing starts and building permits. Now, the reason that this is so important is this helps us gauge new inventory. Now, housing starts and building permits aren't specifically for new home or single family construction. Building permits is kind of construction projects as a whole, but it gives us a general sense of what construction and new building is occurring in the economy. So this is always on an annualized basis. So with building permits, the actual amount that came in is we're on an annualized pace of a little bit over 1.5 million permits for the year. So 1.524 annualized pace is where we're at. This is actually well above expectations of 1.34 million annualized pace. So this is a good sign. More construction. Ultimately, a portion of that leads to more homes being built, single family homes, multi-family homes. This is a good sign that construction and a new construction is working to meet demands of the housing industry. Now, housing starts are going to be specifically for things like single family, like apartments count in this. So it's not all just housing inventory that can be sold, but it's also like apartments, things like that, condos. So actual starts was at 1.45 million annualized pace versus an expectation of 1.31 million. So again, great sign. We got great beats on both permits and starts. This is a good sign that the housing industry new inventory is on its way down the pipe, hopefully to help meet the demand that continues to grow. We also got jobless claims last week, as we do every single Thursday. Jobless claims has been staying pretty steady in the high 100,000 to low 200,000 mark. Actual numbers week over week, we got 192,000 new jobless claims or unemployment claims versus the expectation of 205. So this just goes to the narrative that I've been talking about for feels like months now, that the job market has been staying very, very robust. Despite inflation, despite the layoffs, despite everything that's going on in the economy, we're still seeing the job market stay very, very robust. It's good and it's bad because wage pressured inflation does contribute to inflation. Great for those who are looking to increase wages, their salaries, or looking for a job, but not fantastic, oddly enough, for the economy as a whole and to help out with inflation. On a continuing claim number, so these are individuals that are renewing their unemployment benefits. That actually went down from the expectation. Expectation was a little over 1.7 million, came in a little bit under 1.7 million on continuing jobless claims. Now, looking at the week so far, this again is a huge week. We got today existing home sales, and the importance behind existing home sales is that it makes up 90% of our real estate market. And so existing home sales were actually up 14.5% from where they were in January. Now this is good and bad, mostly good though. And so this is also measured on an annualized pace. So existing home sales up 14.5% to an annualized pace of 4.58 million. The South, where we are here in Texas, good old Lone Star State, the South accounted for 46% of those home sales. And that's a huge number. So if you're a real estate agent and you're watching this, understand that we here in the South and specifically Texas are seeing significantly more activity than a lot of the other areas of the country, which is why, or one more reason why we're not likely to see a real estate crash or home prices drop dramatically. We've got so much more activity. We've got a lot more demand in the South region and specifically Texas. Now, inventory, interestingly enough, remained unchanged at about 980,000 units for sale nationwide. And this is problematic because with the pace of sales increasing, but inventory remaining unchanged, this is basic supply and demand. Supply is staying stagnant while demand is increasing. And so there's a good chance that if this continues over the next several months, we're going to see home prices start to rise again. And to be blunt, I don't think that we've really seen them shrink a whole lot here in the Texas, in Texas, or specifically here in the DFW Metroplex. If so, it may have been of just a minor decrease. But I think if this continues, we're going to start to see that increase. So inventory at 980,000, 2.6 months of supply. A normal healthy market's going to be between 4 and maybe 6 months of supply. So we're still well below that. What's also interesting is of that 980,000, only about 578,000 is actively available for sale. Remember, we've got pending, contingent. Some of these homes are under contract. And so only about 578,000 are actively for sale you can put an offer on. And that puts inventory at about 1.5 months of supply. So inventory continues to be an issue, but that's good for home prices. That's going to continue to keep our home prices strong, and we're going to start to see appreciation in a more robust way going forward, in my opinion. Now, one other note that I'll mention in regards to the makeup of home buyers in February, 27% of home buyers in February were first-time home buyers. And think about it, that makes a ton of sense because you've got a lot of existing homeowners that had an opportunity to refinance or purchase over the last several years, and that might be clinging to that 2.5, 2.75, 3.5 interest rate, and they're more reluctant to say, I'm going to walk away from this low rate and go buy at the rates that we're seeing now, between in the 6s or 7s, depending on what month we looked at, and so they're more reluctant to walk away from that. First-time home buyers don't have that reluctance. They're walking away from rent, which has zero return on investment, as we all know. So 27% of the buyers in February were first-time home buyers. 18% were investors. And this is really critical because if you're a real estate agent and you're not looking at the investor market for additional clients, this could be a fantastic opportunity for you to turn your focus and really start to try and take on some investors. Investors are going to be less sensitive to the market because they're much more focused on long-term picture, big picture. So investors made up 18% of home sales in February, and that was up from 16% in January. So some interesting stats there. All right. So looking ahead to this week, we've got lots of information coming up this week. Most importantly, we've got the Fed meeting, which started today. And then we're going to hear from Fed President Jerome Powell tomorrow. I think that's 1 o'clock Central Time. And this is a critical meeting. The Fed is debating how much to increase the Fed funds rate. If we had asked this question 2.5, 3 weeks ago, the answer would have been, we're probably going to see a 0.5% increase. But with the collapse of Silicon Valley Bank, with the collapse of Signature Bank, with the issues that we just recently saw with Credit Suisse and the UBS purchase of Credit Suisse, it's a different story. The market is torn. Market makers, market analysts are having it a 50-50 chance that we see a 0.25% increase, and the other 50 is no increase whatsoever. And depending on which direction the Fed goes, that's going to influence how the market reacts, but it's also going to influence what happens in the banking world, and it's also going to influence what happens in the mortgage rate world. So we're going to hear from Fed Chair Powell tomorrow. I'm going to talk about that here in a little bit more in a moment. Also ahead this week, as always, on Thursdays, we get jobless claims, both initial and continuing. We get new home sales on Thursday as well, which is important. So we're going to keep an eye out for that. So let's look at what we're focused on going forward. And this is really important. As I mentioned, the Fed's meeting is the #1 focus right now. What are they going to do? Are we going to see them stay put and pause on their Fed funds increases? For those tuning in for the first time, as a reminder, Fed funds rate, short-term kind of overnight banking rates, that does not have a direct impact on mortgage rates. It does impact, however, things like lines of credit, auto loans, credit cards, things that have variable rates. All of that are influenced by the Fed funds rate. The mortgage rates are influenced by the price of mortgage-backed securities or mortgage bonds. So just a note on that. So 0% or 0.25%. The question is how is the market going to react? If the Fed increases by 0.25%, that's going to put more pressure on the banking world. Part of how the whole banking collapses and the banking turmoil happened was with Fed increasing the Fed funds rate. and I'll talk more about that in a moment. So it's going to put more pressure and could cause more turmoil in the banking world, and the market may not like that. However, if the Fed does not increase the Fed funds rate, that could lead the market to take the stance that the Fed is not able to maintain their focus on bringing inflation down to that core target of 2%. And that could open the door for inflation to pick back up. And obviously, if inflation rises or stays stagnant at the current levels, it's going to mean a lot more cost for consumers over a longer period of time. So tomorrow's rate decision, very, very critical. And then the commentary that we get from Jerome Powell at his press conference at 1 o'clock is also going to give us a lot more insight, and the market's going to react. So be ready for that. All right. So I promised you guys a little bit of bonus information on the SVB collapse. I'm going to try and do this in 30 to 60 seconds. If you haven't been paying attention, if you've lived under a rock, a couple weeks ago now on a Friday, we saw Silicon Valley Bank, SVB, get taken over into conservatorship from the FDIC. And this was a huge deal. Silicon Valley Bank was the nation's 16th largest bank, and this sparked chaos in the banking world. Ultimately, in a snapshot, what happened was SVB happens to cater to the tech and startup industry. Over the last 3 years, many IPOs, new companies hitting the market, new companies going public, generate a lot of cash. In addition to that, the tech industry, the tech sector has had a complete boon during the pandemic. 2020 all the way through probably halfway 2022, the tech sector absolutely blew up. You had so many people at home, a lot more tech was utilized. Facebook, Pinterest, TikTok, Instagram, everything blew up that you can think of. So what this ultimately ended up having was tech companies were flush with cash. What are they going to do with that cash? They're going to stick it in their bank. So SVB was flush with deposits from tech companies for that period of that 2.5 year period. And SVB wanted to take the excess capital that they had. They're required by law to keep a certain percentage, usually around 10%, as reserves. And the additional funds, like any good investor, they want to make that money work for them. Now, in the case of SVB, they put the money to work in 2% treasury bonds. The 2-year treasury bonds, not 2%, 2-year treasury bonds. Now, the hurdle in hindsight was that these 2-year treasury bonds were paying something along the lines of 1.5%. Then, once the Fed started increasing the Fed funds rates, a couple things happened. One, in the tech industry, we saw IPOs dry up. We saw the number of IPOs coming out, new companies going public, that dropped significantly, which hurt Silicon Valley, among other banks. And then we also saw the tech sector start burning cash on a heavier basis. It cost them more money to operate their business, so that way they were going through cash at a faster pace. And ultimately that meant deposits were coming out of their bank because they were going through that cash faster. So Silicon Valley Bank's deposits started declining. They eventually got to the point where Silicon Valley had to raise capital to make sure that they could maintain the adequate amount of reserves. Well, going back to the 2-year treasuries that they were holding in the neighborhood of 1.5%, as the Fed increased the Fed funds rate, new treasuries are issued at higher yields. So if you took $10,000 and you bought a 2-year treasury at let's call it a 2% yield, and then a year later, you could take that same 10,000 and buy a 2-year treasury at a 4% yield, which is a better investment for your $10,000. Obviously, the 4% yield is. Well, here's the problem. If you're holding $10,000 worth of 2-year treasuries at a 2% yield, if you want to sell them, they are no longer worth $10,000. They are worth, if current yields are 4%, probably somewhere in the neighborhood of $5,000. So your $10,000 investment is now worth $5,000 if you want to sell them. Well, Silicon Valley Bank was forced to raise capital, and they sold a portion of their bond portfolio, resulting in a $1.8 billion loss. This sparked additional fears from customers and caused more deposits to flee from Silicon Valley Bank, causing them to have to raise additional capital. They attempted to raise or issue $1.25 billion in additional common share stock. that initiative failed and ultimately led to them being taken into conservatorship by the FDIC. I think it was 2 weeks ago or 3 weeks ago this coming Friday, I believe. So in a nutshell, that's what happened in Silicon Valley Bank. And ultimately, subsequently, Signature Bank resulted in a very similar path, and they got taken under conservatorship by the FDIC that following Sunday. Monday, Republic Bank was in trouble. They're still operating, but definitely still in trouble. And so that is, in a nutshell, the turmoil of everything that's going on in the banking world right now. And if the Fed increases the Fed funds rate, that's going to put additional pressure on banks because a lot of them are sitting on a significant amount of bonds or treasury bonds at lower yields because they were bought back in 2020, 2021 when yields were significantly lower. So there's your bonus content for today. The last thing that I want to mention is we are moving in the right direction. We are seeing deflationary data in events. The bank crisis, although it is problematic, is technically a deflationary event. And then we also, as I mentioned earlier, saw producer price index or PPI decline a little bit as well. And we hope to see that translate into lower consumer price inflation on the next CPI report next month. So lots of very interesting economic impacting events and information to watch, but our focus right now is on the Fed meeting and Jerome Powell's comments tomorrow. So that is our episode today. Oh my gosh, thank you so much for joining me. If you are watching on our private Facebook group, thank you so much for being part of our amazing community. If you're checking us out on the YouTube channel, make sure you hit that subscribe button so that way you get the latest updated economic and real estate information at the palm of your fingertips. For the SRT Live, I am Sean Richard of the Sean Richard Mortgage team. Thanks so much for joining me today. Have an incredible rest of your week. Take care.